What's up, guys? It's Brendan from Market Makers, your home for advanced Fibonacci, TA, and Wyckoff price method. We need to talk about the super bubble, guys. A key event is occurring in all of the indexes. You guys know I've been tracking this very closely. I made a previous video about this as well. But what's happening now and what you're hearing the talking heads on TV talk about is the potential revisitation of the January lows, denoted here with this curve, okay? Now, to somebody who's not a technical trader, what they're looking for is just, oh, let's see if we can test this January low and get a double bottom and then move back up. This is possible. It is also possible you break through these January lows and you are still in markdown, because remember, in Wyckoff we have been in distribution and we exited distribution. We formed a new accumulation box, and right now this accumulation box is about to be tested. We could get a down thrust candle, or we could exit the trading range and enter markdown again to move further down all of the indexes, including crypto. In this video, we're going to go over SPX, we're going to go over the Nasdaq, the Russell 2K, and Bitcoin, representative of crypto. You guys need to understand the type of damage we are talking about. There's only been 3 previous super bubbles in the history of the last 100 years in the USA, okay? The first one was in 1929. We're not going to focus too much on that one because the other 2 super bubbles occurred in the last 22 years. This is the 4th super bubble, but what's unique about this super bubble, the previous one in the dot-com in March of 2000, that was a specialized equity class super bubble. The 2007 was a housing bubble, the first one that's ever happened in the country. And a super bubble is a 3 sigma event. These are 3 standard deviations away from long-term trend. Long-term trend, give or take 100 or 200 points for the S&P, is about 2,500. S&P is trading at 4,300. When the S&P hit 3,500, that gave it a 2 sigma, 2 standard deviation, which is a bubble. When it hit 4,500, that was a 3 sigma, 3 standard deviation bubble, and it actually hit 4,820. Now, what's unique about this is it's not just equities. You have the highest price bond market of all time. You have interest rates at 0%, the lowest in history, 0%. You have the housing market, which has now surpassed the peak of the 2007 housing bubble. The median household income required to buy a house now is at a higher multiple than it was in 2007. So you have a housing market bubble, and you combine that with record high inflation over the last 4 decades. They say the inflation, the Fed says it's 7.5%. If you use the same Fed templates from the late 70s, early 80s, inflation right now is almost 16%, and everybody who buys groceries or buys any commodities that they need, such as gasoline, understands the price has risen substantially. On top of that, we have the Fed printed 40% of the money supply since COVID crash. 40% of the money supply in circulation, which is inflating, which is what inflation is. The money supply, it devalues your currency and overvalues these marketplaces. And on top of that, they've been buying $40 billion a month in mortgage-backed securities. This bubble is unique because it is the first multi-pronged bubble covering 4 marketplaces: equities, bonds, commodities, cryptos, and housing. Now, I said 4, and that's 5. But the difference with commodities is some of these are moving up substantially, and some of these are not necessarily because of the bubble. It has to do with more supply and things like the possible event of war in Eastern Europe, which is the case for oil as well. So really, it is a 4 asset class bubble, and it's something you need to track because many people are going to get wiped out. Many people get wiped out in these bubbles because they're passive investors. They just invest and they say, you know what, I'm going to stick it in a mutual fund, let it sit there 20, 30 years. And if I did that back in 1990 or at 2000, look where I am now. I have record profits. Yes, that's very true. But if you look at the bubble history, when the 1929 bubble crashed, which is a super bubble, you did not get back to those highs till 1954, 25 years later. When the dot-com bubble broke, you did not get back to those highs until 2011 or 2012. So these are specialized bubbles, and this is a broad bubble, potentially doing so much more damage than a normal market bubble. This is a super bubble, but literally it is like a super bubble squared. Okay, this is a very, very powerful event that could occur. Let's go ahead and look at the marketplace, and I want to show you guys. So look, as you can see, we're moving down to test this January low. This is the futures. Obviously today's President's Day, so we don't have the markets open right now, but you can see you're working on this death cross. Again, the Russell 2K and Bitcoin already has it. We need to zoom out and go to the March 2020 lows. Look at this parabolic rise for the S&P. The S&P typically returns 10% a year. 10% a year, and let's see what it did here. If you go back to your COVID lows, to your all-time high, the S&P returned 121%. So from March 2020 to basically where you got to on your all-time high here, January, so just under 2 years, you returned over 121%, when normally that time period in a bull market would be 20%. So you can see you 6x your normal size returns with the Fed interfering in the marketplace. Let's go ahead and look at some price declinations, because you guys need to understand what's happening here in the price and where this could move to. We have history on the price declinations. These are not made up numbers. So the dot-com crash, like I said, March 2000, TMT, Tech Media Telecom, started to break. The basic way to view a super bubble is it's a malignant cancer, and the tentacles spread. They start off with the high growth stocks. They spread to the larger caps. The S&P stays strongest the longest. It did this in the 1929 crash. It did it in March, and it did it in the dot-com bubble, and it did it in the housing crisis too. So what you have happen is in March, the bubble begins to burst. The high-flying companies, the hyperspec companies, get shaken out by September. Tech Media Telecom, which was 30% of the marketplace, was down 50%, but the S&P was at its co-equal high from March. Over the next 2.5 years, the S&P declined 50%. 50%. The Nasdaq went down 82%, and Amazon went down 92%. The housing bubble, the first Three Sigma event for housing in our country's history, went down and caused the market to crash, the SPX, 50% once again, okay? So we have two SPX crashes of over 50%, or just at 50% over the last 20 years. So we can gauge where this would go, and I want to show you this in a Fibonacci wave projection as well. So let's go ahead and look at this. Taking our price declination from the all-time high, just to get to the 2618, which is at 3211. Right now we are trading at 4300. You're looking at a 33% move to the downside from the all-time high. To get to the 4236, which brings you just under trend at 2357 on the SPX, there's your 50%. That is a 51% move. Pulling COVID, see exactly where this gets you to. Do you see this? You're at the base here of COVID. These bottom candles from the COVID crash. That coincidentally is also your long-term trend. So basically the way to view this is you're giving up the Fed pump. All the liquidity pumped into the marketplace, all of the money printing pumped into the marketplace, the asset purchasing, the lowering of the interest rates to 0%, all of that's coming back, and you're returning basically to your COVID lows here on the SPX. Now the SPX, as I said, is the strongest of the indexes, and of all of the indexes is the one capable of making a new all-time high, okay? Because you're not that far off your all-time high. Let's go ahead and look at this. Your all-time high here at 4820. Get that just about perfect, 48.18, to where you're trading, and we know we're dipping down potentially to test our January lows. That's an 11% move, okay? So that's an 11% move. If you did turn more bullish on the SPX, you could move up. You are below your 233, a key moving average, obviously, and you do have a potentially incoming death cross. But to give you that idea, the COVID lows in all these marketplaces is where every single index could be getting to based on long-term trend and based on previous price declination in bubbles. Now the grandfather bubble, guys, in a nightmare scenario, which was the only dual market bubble, which literally was an equities bubble and was also a housing market bubble, to give you a timeline for trading again, because again, that hodl mentality is super strong. The grandfather bubble is Japan, 1989. They had a housing bubble and an equities bubble. And you say, well, we had a housing bubble and an equities bubble. Equities wasn't in a bubble in 2007. The SPX came down 50%, largely due to the financial instruments such as subprime that all these idiot banks had massive exposure to. That's what brought the marketplace down. We just had a pure Three Sigma housing bubble. Japan had a Three Sigma equities bubble and a Three Sigma housing bubble. Those 1989 highs from today in 2022 have still not been reached. Over 30 years, they have not reached their 1989 highs in either one of those marketplaces. That should tell you something about how powerful these bubbles can be. If you listen to some people like Jim Rickards, he says this is a depression era event, okay? So it'd be really interesting to see how everything unwinds, and this is an event you can capitalize on as a trader. You can make money on the way down and you can buy at the bottom, okay? There's an expression, millionaires are made in bull markets, billionaires are made in bear markets. So that's something that if you guys want to understand the education and how you can trade trends and trade in these markets and be more of an active investor, active trader, definitely check out our Discord link in the video description. Let's look at the Nasdaq. Again, Nasdaq history went down 82% from the dot-com crash. Let's go to the COVID lows again. The symmetry in the marketplaces is incredible. They're basically all testing their January lows. Let's go up to the market high and look at this move in the Nasdaq. 152%, more than double. Okay, more than doubled between March of 2020 and November 22nd, 2021. So basically, in a course of what is that, 18, 20 months? Again, under 2 years, the NASDAQ more than doubled. That is a blow off top, okay? That is a blow off top. It is a strong bull run up. Look at the separation again of the 55 and 233. Even with the Wyckoff back up before our last sign of strength, getting us into the distribution box, making our series of volatility moves and our up thrust and the exit again in January, the market's all tracking extremely similarly. The exit from the distribution box, and we are already testing here in the futures market. We are testing our January lows. You see this? And depending what happens, remember futures, this is lower volume. So we got to see what the market open does tomorrow, but you are literally testing your lows right now. And if you start showing more weakness, something you have to pay attention to, a hallmark signifier of an incoming bear market is the death cross, the 55-233, which it's working on right now, okay? Let's go ahead and get some price wave moves so you guys can see the type of punishment the NASDAQ is capable of dealing out to these hedge fund managers that you see on TV and these people that just keep recommending high growth tech stocks. Think ARC Innovation, Cathie Wood. At one point, her innovation fund was up over, I think, $175. It is minus 60% plus now. Minus 60% plus to show you how much damage these high growth stocks can do. Look at this. This is a list here, just 10 of them. PayPal minus 44%, Moderna minus 42%, Etsy minus 40%, Meta minus 38.2%. Now Meta's Facebook, and this number is very misleading because they hold the distinction now of the biggest market dump in history for a single day of $232 billion when they went down. $232 billion. Again, remember, malignant cancer, the high growth stocks are getting hit. And then what happens is that cancer spreads to the companies that are actually making money. And then the whole thing rolls over. And that's when the market really starts to dump. And the question doesn't seem to be, are we going to crash? We are definitely going to crash, in my opinion. The question seems to be, will it take a period of years like it did in the dot-com bubble, or could this be quick? And that's the unknown. And so much of that is the Fed, and it depends what they do, because they want to ideally have a soft landing where the market gradually declines and prices normalize. So we have to see how that happens. And of course, Netflix minus 35%. Some of these other companies may not heard of. Teradyne minus 30%. So that's just an example here. Let's go back to the NASDAQ. NASDAQ's testing its lows. Let's get our wave projections. You guys got to see this declination in price here. So let's go ahead and start up here. Again, we know where the NASDAQ's capable of moving. The 1618, which would take the NASDAQ from 13,765, would bring you down to 10,489. That is a 37% move. Okay, 37% move would take you down there. Let's see where the 2618 is. The 2618 is a 55% move. Let me pull this up so you can see it. That is at 75.33, and if memory serves me correctly, that is basically in the COVID neighborhood because we more than doubled, remember? So here's your COVID line. Here's your COVID cluster. And look at that. You are basically in that neighborhood, and that is a 55% move. Now remember, the Nasdaq is capable, as demonstrated, of declining 80 plus percent. So again, the 80 plus percent move is at 83%. The 4236 Fibonacci number. Keep in mind, these numbers seem surreal. The Nasdaq is at 13,770 as the time of recording this. This would bring you down to 2,749. 2,749. And again, this is in a potentially worst case scenario, but again, I could say worst case, but I don't know if that's accurate because the Nasdaq already did this 20 years ago. It already did this exact move. So could it go lower? There's not much lower you can go, but yes, I guess it could. So your realistic target, depending on intervention, depending on variables that none of us know about, Fed actions, things like that, the 2618 returning you back to your trend prior to, once again, the massive Fed intervention, the massive government intervention to the markets. This is a very realistic target, and this is a likely target. Your realistic target would bring you back to where you were around the COVID time period of 7,533. Jumping over to the Russell. Again, the Russell already has a death cross that holds that distinction with Bitcoin. You can see the 55,233 cross up here. Again, the Russell parabolic move. Let's just go from March. Let's go ahead and measure this out. March, let's grab one of these bottom candles all the way to our up thrust candle here. Try to get the very tippy top. There we go. Let's see what this move was. A 158% move, and it hit this back on November. Co-equal basically with the Nasdaq, right? So they hit this back in November, basically 18-20 months, and the Russell typically returns 11 or 12% a year, and basically in under 2 years it returned 160%. Your blow off top, symbolic here of your Wyckoff distribution, which of course you exited, and you exited this in January and you crossed in the death cross. The Russell looks to be the worst of the indexes because of the meme stocks, because of the high growth stocks here. These indexes, again, the SPX I think could rebound, depending on the Fed news. The Nasdaq could rebound some, but I don't see a new all-time high. I don't see a new all-time high for the Russell. They have too much damage. Every single one of these indexes, by the way, only 1/3 of their stocks is above the 200-day moving average. Only 1/3 is above the 200 or 233, okay? The 2/3 of the stocks are below that 233 or 200-day moving average. So the big companies, think Google's, Apple's, Teslas, they're keeping these indexes afloat, but the majority of them are below the trend for going into a bear market. So it is a struggle. We have to see the market sentiment, what happens here. And as you can see, we look to be declining to visit our lows as well. So let's go ahead and get some wave projections here from the all-time high. I guess I can probably pull this over. It'd be easier to do it this way. So let's see where their COVID low would take us. Let me go ahead and grab my price time tool. The 2618 would take us back to 1,066. And let's see where this lines up with COVID. Okay, so your 2618 brings you to the COVID lows. That is a 56% move. Again, will the Russell track with the Nasdaq, or will it track with the SPX? The SPX has demonstrated twice in the last 20 years it will decline by 50%. If it tracks to the SPX, you're going back to your COVID lows here in the Russell, just like the SPX is. And if it tracks to the Nasdaq, you're going to your 4236, just like the Nasdaq. And in that case, you are at 424. So the Russell right now is trading at 1,985, and it would be declining to 424, which is an 82% move in the Russell. The 2618 is at 1,066, which would keep it in line with the percentage decline of the SPX. Let's jump to Bitcoin. These numbers are massive, guys. Massive numbers. Bitcoin, I'm going to show you this on the weekly because it's so much easier. Your March is right here at the X point of this pattern. I've been sharing this pattern since November. This is a Navarro pattern. Let's look at this. If you take your trend-based fib from point A, the previous all-time high, to the market low, to the current all-time high, you get phi, the 1618, the golden ratio at 10,630 on a wave projection down, okay? This happens to line up perfectly, which is why I have it this way, perfectly with the 886 of this Navarro pattern. Now, I have a couple things to say about this. One thing is your COVID low for Bitcoin is 3,893 on BitGet, okay? 3,893. If the other markets go to their COVID low, 100% expect this market to go to its COVID low too. And I know that drives people nuts, but you would be looking at 4K Bitcoin if the other markets go. Now, most of these markets and super bubbles have a tendency to go below trend. And if that happens, you would be talking, and I know this sounds crazy and people can curse me out, whatever you want in the comments, but you would be talking statistically being below the COVID low, which means below 4,000, which is insane. And maybe it can't get there. Maybe there's too much money. But guys, once again, this event that is going to occur, and a lot of it depends if it happens quickly or slowly, has never happened before. We've had super bubbles before. We have never had a four market super bubble ever in the history of our country. So nobody knows what to predict. I'm giving you projections on price based on patterns, based on history. And this is where Bitcoin is showing me on a pattern, 10,630, which is being extremely generous. I would expect 4K Bitcoin if we hit the COVID lows in the other markets. All right, guys, hope you enjoyed this video. Definitely help me out. Hit the like button, send it out to your friends and family that like this type of video. Would really appreciate it. And of course, I will answer your comments if you post them in the video comment area. And check out our Discord, and we trade on BitGet and Twitter. All our links are in the video description. Hope to see you guys in the room. Talk soon, everybody. Enjoy.